monetizations, right? And we have seen in the last couple of years about $11 billion of monetizations in the non-traded REIT space. I'm just going to put this up to the advisors for a moment, bankers and Gil. Is boards, and you work with either special committees, management teams, advisors, et cetera, have you seen them consider issues differently today than they had in the past? Do you expect to see changes as they think about how they want to potentially monetize these opportunities going forward?
You know, Lisa, I think that look, the microscope is always on these companies, particularly today, because so many of them are coming up of kind of life cycle. And so when you have so many investors in something, they said where it was 45,000, 90,000 per fund in many cases. You know, every board, whether it's a public board, private board, non-traded board, etc., I think in this day and age takes their responsibilities very, very seriously. And so they all will go through and should go through the various things that can happen, whether a company goes public, whether it's just listed, whether it's sold, and they should go through the various range of activities and make sure they're getting the best price. And I think that, Nick, you can speak to this. You have a lot of boards that have been through this process. It's boards are focused on this, and they should be, and investors are. And if they are not, and the results aren't what they should be, then a lot of money won't get raised. It's that simple. And so this industry will succeed because the monetizations will succeed. And if they don't, they won't raise capital. It's no different than any other business.
Okay. I think that there are a few primary differences. One is the breadth, as Jeff alluded to, of available strategic alternatives to the non-traded REITs today, particularly with the listing and concurrent tender raises of 2012 that many are studying today. That does actually bring a little bit of an issue on competing objectives that the board may have, right? So is your objective to provide near-term liquidity to your existing shareholders, in which case you may choose a listing strategy, or is it the long-term shareholders in for that long-term and where you may take a slightly lower valuation and raise capital and preserve the balance sheet, but you are impairing those who are looking for near-term liquidity. So are you playing to the long-term new investor, the institutional investor you're looking to get in there and drive value, or the existing shareholder? I think, two, you've got these sponsors that have put significant time and capital to develop very valuable asset management platforms. Today, the public markets have spoken. There's a strong aversion to internalization transactions. There's an aversion to externally advised structures. And so there is a conflict, I think, today at the board level between the sponsors and the boards as they seek certain of these liquidity alternatives. Certainly you can manage through that, but it's more complicated certainly than it was 5 years ago. And then I think the final aspect that's more pronounced and is across the board in the listed space. It's not, the non-traded REITs are certainly not immune to shareholder activism. And they should just assume that any decision that they make regarding liquidity events or strategic alternatives are going to be second-guessed.
You know, one of the things that I think that there's a presumption out there in REIT land generally. I think that presumption exists in traded REITs and non-traded REITs, that boards are not independent. And I actually think that that's somewhat sad because in my experience, 30 years practicing law, more often it's the case that they thought the board that's independent wants to do the right thing. And I actually think that what we shouldn't do, notwithstanding Mr. Bidover's commentary, is go to a regime where sponsors of non-traded REITs are their hands are tied with respect to how they're going to maximize the value that Randy talks about in terms of that exit strategy. So, and Hsieh talked today this morning very thoughtfully about the fact that his asset base is so large. He's not 70% levered. He just has lots of funds underneath Prologis, and he has lots of constituencies that he has to deal with. And I assume that most people wouldn't doubt that Prologis' board is thoughtful about how they deal with those. I think that the non-exchange traded REIT space will mature into that. People thinking that they're as thoughtful as public REITs.
Lisa, I think one other thing too is, you know, like I said, we kind of referenced it was a pre-2007 sort of type of non-traded REIT business, and I'd say post-2008. I think boards today of the newer vehicles have grown quite a bit, and a lot of it's off of some of the innovation that Nick's company has done. You know, a lot of these REITs now are smaller, so by being smaller, they sort of have very specific vintage window of assets that they're acquiring, as opposed to crossing over vintage, cycles basically, so they can control what they're buying at that time. Companies don't get so large. Second thing that's happened is obviously there's been a big pushback against internalizations. So in years past, that's how managers got paid. Going forward, it's basically more like promoted, if the investor did well, the sponsor does well. It's no different than what Blackstone does, right? Managers like that. So I think that the benefit today for boards that are sitting on these companies, they've seen listings, they've seen reverse mergers, they've seen dispos. There is, and then I think they've also seen the benefit of smaller sized, targeted vintage strategies, and that's been very successful. So I think it all lays out very well for investors to look at this space. The other thing is, you heard it on some of the